Hello students. So in our previous class, this was the last slide which I have taught that this is the particular format of calculation of computation of income from long-term capital gain or short-term capital gain. So we can see here that we are starting with the sale value. Then we will deduct the index cost of acquisition, the index cost of improvement, and the other expenditures which were occurred at the time of sale. Then from there we will get the long-term capital gain, and after that same procedure for the short-term capital gain. First the sale value, then from there we will deduct the cost of acquisition, the cost of improvement, and any other expenditure at the time of sale, and we will get the short-term capital gain. So the total capital gain will be the total of long-term capital gain and the short-term capital gain. Clear? So now take an example. So this is a sum for you, a very small sum. But if you can do this sum, it will be clear for you to get the whole idea on the capital gain. A Hindu undivided family purchased a house on 1/7/2006. It means on 2006/7, the cost of inflation index is 122 for rupees 16 lakh. It sold the house on 10/11/2018 for 40 lakhs. On 14th December 2018, it was purchased another house at Gurgaon at a total cost of rupees 5.6 lakhs. It did not own any other house property. Compute the income chargeable under the head capital gains. So now we will solve the sum. Look at the sum. So normally there are the two columns, the particulars and the amounts. So first the selling price, the sales consideration. Now remember, in some book or in the some notes, you will get the selling price, but in some home, you will get the sale price of the house. So it's up to you whether you will write the sales consideration or the selling price. But according to income tax in 1961, their consideration, it will be the sales consideration. So the sales consideration is 40 lakhs. From there, we are deducting the index cost of acquisition. Now look, the purchase price was 16 lakh, and from there it is 280 divided by 122. Now remember, in the upper portion, we will write the index of the year of sale. So the index of the year of sale, where the 17/18 is to 80, and the below it will be index of the year of purchase, and it was given in the sum that index for CIA was 122 on the year of purchase, so it is 122 there. So from this calculation we will get 36,72,131. So from selling price, we are deducting the index cost of acquisition, and in the sum they have not mentioned any cost of improvement or any other expenses at the time of sale. So if there were any other expenses, we will deduct it from the 40 lakhs. So by deducting 36,72,131 from 40 lakh, we are getting 327,869. Now what is the exemption under section 54? Now look at the sum. In the sum, after purchasing, they have purchased another house at Gurgaon for rupees 5.6 lakhs on 14/12/2018. That means after selling the house. So it means that person will get a deduction of the minimum amount of this 5.6 lakhs and the capital gain which he had occurred. Now look at the sum. Look at the solution. His actual long-term capital gain was 3,27,869, and the price of the house was 5.6 lakhs. So out of these two amounts, 327,869 is minimum. So we will deduct this amount from there. So once again, under section 54 exemption, the rule is after the capital gain, if anybody purchase the house, he or she will get an exemption under section 54. Now, how much will be the exemption? The exemption value will be the actual price of the house which he will purchase and the long-term capital gain which he has incurred. In this sum, the house he has purchased, the value was 5.6 lakhs, and the long-term capital gain so far is 327,869. So out of these two amount, this is the minimum amount. So we are deducting the same amount from here. So our taxable long-term capital gain is nil. Now there is a possible somebody will ask you if this amount is greater. If this amount is greater than this one, then what will happen? That is not possible, because under section 54 it is clearly mentioned that the long-term capital gain, means the capital gain which you had incurred so far, will be the maximum limit. So the taxable long-term capital gain can be nil, but it can't be negative. Okay. So this is a solution, but a very small solution for calculating the long-term capital gain. Now I'm going to the next slide. Now there is a concept of capital loss and carry forward procedure. Now what is a capital loss? We know what capital gain is. Capital gain means, so whatever we are earning extra by selling any capital asset. It means the more the value of the selling price of than the purchase price, the more will be the gain. Now same can be incurred at the time of loss. So if the selling price is less than the cost of acquisition and the cost of improvement and the other expenses, then there is a possibility that we will earn a capital loss. Now, the capital loss arising to a taxpayer can only be set off against income from the same head. That is, it can only be set off against income arising under the head capital gains and cannot be set off against income arising under the following heads, means the other four heads: the salary, the house property, the business and profession, and the other sources. I'm giving an example. Suppose you have two houses, okay, and you have sold both the houses. Now, when you are selling the house one, suppose your capital loss is 4 lakh, and when you are selling the house 2, your capital gain is 5 lakh. Okay, so it means the total income of capital gain will be 5 lakh minus 4 lakh will be the 1 lakh. So it means you are actually setting off the loss of that house 1 with the profit arising from the house 2. It means you are actually setting off the income from capital gain of a particular head with the same head, the capital gain. But if the situation is like that, if you incur a capital loss under the head capital gain for rupees 6 lakh, but from the other four heads, suppose you have 10 lakh, 40 lakh, 30 lakh, you have a huge gain. So you will say, sir, okay, when you are calculating the actual taxable income, so the total of these four heads minus capital gain. No, that's wrong. You cannot do that. The capital loss arising out of capital gain can only be set off against a capital gain. So it means, in a nutshell, a capital loss can only be set off against a capital gain, not with the any other heads. Now, what will happen if you don't have any capital gain in a year, but you have a capital loss? So it means that amount, that loss will be carried forward to the next financial year. So that is known as the carry forward. So set off means you are deducting or balancing or minimizing your loss with other gains with the same head. And carry forward means if you don't have the other heads or with the same head to make it minimum or make it nullify, you are going to the next financial year for the carry forward procedure. Now look at the screen. If any long-term capital loss arises from the sale of any asset, it is allowed to be set off against long-term capital gains arising from the sale of asset. So it means it is very easy that our capital loss can be set off only against a capital loss. But what will happen if there is a short-term capital loss? Short-term capital loss arising from in the sale of the asset, that is shares and mutual fund, is allowed to be set off against any income on the short term or long term. So it is very clear from that. Long term loss only against the long term gain. But if it is a short term loss, it can be adjusted against the long term capital gain or the short term capital gain. Now, if a capital loss cannot be set off from the head during the same year, it shall be carried forward to the next year and allowed to be set off against capital gains arising in the next year. After carrying forward loss, the losses to the next year setup would be done in the same manner as the mentioned above, but it should be maximum for 8 years. So if you are incurring loss on a particular year, and in the coming consecutive years you don't have any gain, that loss will be carried forward to the continuously, but that is only allowable up to 8 years. So carry forward is allowable for capital loss only for 8 years. Now there are some compulsory returns and belated return rules. So we will come to the later. Now take an example, another example. Now look at the screen. Now a person got many assets and he is selling them. Somewhere he is earning some losses, somewhere he is earning some gains. So we will do one by one. First he is gaining from a house 10,500. Then he sold equity shares, Securities Stock Exchange, which was purchased by him on 142 for 66,000. STT means security transaction tax paid on fair market value of the shares, and then he sold another agricultural land, and then he sold another flat. So he has 1, 2, 3, 4, 4 capital assets. Now we will see whether it's a long term or short term. So let's do the sum. So very fast one, we don't have to calculate anything, just straightforward way to putting the amount 10,500. But look at the second. The capital gain from sale of equity shares of Thapar Limited sales consideration is 2 lakh. And then the cost of acquisition. Now, the cost of acquisition calculation is very easy. The purchase price of the share into the CII of the year of sale, means the current financial year, divided by the year of purchase. Then in the previous financial year, up to the 2016-17, we are actually deducting this STT, but now the section has been abolished, so we don't have to deduct any security transaction tax. So the from 2 lakh 1,75,000, we are getting the 25,000. Then after that, for the sale of flat, the sales consideration is 11,82,000. Then same, look at the sum. Yes, the selling price is 11,82,000. Purchase price was 60,000, and the fair market value of the first was 3,80,000. Now look at this. The date is 1/1/1977, but we know the base year is about 2001-2. So remember, if the purchase incurred before 2001-2, there should be a fair market value in the sum, and we will take that fair market value at the time of cost of acquisition. So we are taking here 3,80,000 into 280, the current index of the financial year, and the year of purchase. Now, because we have the year of purchase in 1977, but that is before the base year, so we are actually taking the FMV, means the fair market value. And whenever we are taking the FMV, we have to consider the base. The base 2001-2 is 100. So it is 280 by 100, then 10,64,000. So deducting from this amount, we are getting this amount, and the total taxable capital gain is the addition of these figures. So from the sale of house, from the sale of the equity shares, and from the sale of flat, the total capital gain is 1,43,500. We don't have any exemptions or 54. We have not purchased anything. So the sum ends here. So that's a complete sum on income from capital gain, both from the long term and from the short term. I hope you enjoy. If you have any query, you can contact me. Thank you.